Law. I, Professor Kunal Shah, is over here to present you all the marathon revision for CA Foundation Business Law. Friends, till now we have successfully completed a topic called as Indian Contract Act 1872. We also completed Partnership Act 1932. And in our yesterday's lecture, we had commenced with a topic called as Companies Act 2013. Yes, friends, we are going to continue with this topic, that is Companies Act 2013. And in today's lecture itself, we are also going to start with a new chapter, that is Sale of Goods Act 1930. But before that, let us wind up the chapter which we had already begun yesterday, which was Companies Act 2013. Yes, friends, in my yesterday's lecture, I had shared with you all the concepts towards introduction of Companies Act 2013, wherein I also told you about the definition of a company, various characteristics of a company, and yes, we also discussed a provision towards lifting of a corporate will. Now, friends, in today's lecture, we are going to cover the concept called as classification of companies, promoter of a company, incorporation of a company, memorandum of association and articles of association, and the last topic will be the important three doctrines, that is doctrine of ultra vires, doctrine of constructive notice, and doctrine of indoor management. So let us begin our portion with the topic called as classification of a company. Yes, friends. Yes, friends. The word company, which we already know, is been defined under section number 2, clause 20. The word company, which we already know, is been defined under section number 2, clause 20. Yes, friends. A company can be classified into various headings. But over here, I have particularly classified a company under three headings only. I have classified a company, number one, on the basis of incorporation. Then the same company can be classified on the basis of liability. And last, the company can be classified on the basis of control. So yes, friends, a company can be classified over here under three headings. That is on the basis of incorporation, on the basis of liability, and on the basis of control. Let us first of all discuss the provisions towards classification of a company on the basis of incorporation. On the basis of incorporation, we have to understand a chartered company, a statutory company, and a registered company. First of all, what do you mean by a chartered company? Yes, friends, a chartered company is a company which is formed under a royal charter. A company which is formed under a royal charter. Royal means something which is belonging to a king or a queen. Charter stands for constitution. So any company which has been getting formed on the basis of royal charter, that royal charter is actually been prepared by the royal family. So friends, chartered company is a company which is formed under a royal charter. The royal charter is been prepared by the royal family. To be more precise, it is a company which is owned, controlled, and managed by a king or a queen. Any such company which is owned, managed, and controlled by a king or a queen, then such companies are called as chartered companies. Yes, friends, being a chartered company, they never ever follow Companies Act 2013. Sir, why will they not follow the provisions of Companies Act 2013? Because of a very simple reason. Because of a very simple reason. Law says that a chartered company is a company formed under a royal charter. When the company itself is formed under a royal charter, when the company itself is been formed under a royal charter, then in that case, The company is not required to follow Companies Act 2013 because the company has been formed as per the Royal Charter. Yes, friends, a very important point over here. Such companies are not in existence in India. Yes, in India, you won't find out such companies. But yes, such companies were there in India. The best example I can give you over here is about East India Company. East India Company is the pure example of a chartered company. So let us begin. Let us begin. Chartered company is a company formed under a royal charter. The royal charter has been prepared by the royal family. The company is owned, controlled, and managed by king or a queen. Do such company follow Companies Act 2013? No. Acha, are such companies in existence in India? No. But were there any such companies in India before? Yes. The best example over here is East India Company. So with this, friends, we have completed the provisions towards chartered company. Now let us understand the next concept, which is nothing but a statutory company. What do you mean by a statutory company? See, the word statutory itself has been derived from a word called as a statute. Statute stands for law. So any company which is formed under its own law, I repeat my statement, any company which has been formed under its own law, then such companies are called as a statutory companies. Over here, such companies are also registered under their own act. So first of all, the company is been formed under its own law. The company is registered under its own act, which means it is a company which is being set up by the separate act of parliament. Because in India, it is a parliament who has got the power to prepare a law, to prepare an act. The company is formed under its own law. The company is formed under its own law, and the company is registered under its own act. Layman persons like me, you, and Mukesh Ambani, we can't have our own act. We can't have our own law. It is the parliament who has got the powers to enact the laws. So statutory companies are nothing but a company which has been formed under a separate act of parliament. Yes, the best example over here is nothing but our own institute, that is ICAI. Yes, if you have a look upon the name of ICI, then below its name it has been written, set up under the separate act of parliament. In order to form ICI, we had to first form Chartered Accountants Law. Then the company was registered under an act called as Chartered Accountants Act 1949. So statutory company is a company formed under its own law. The company is registered under its own act. In fact, it is a company which has been set up under the separate act of parliament. Sir, do such company follow Companies Act? Law says yes. Yes, they will follow Companies Act, but only to some extent. They will follow Companies Act, but only to some extent. Whenever there is a dispute between its own act and Companies Act, whenever there is a dispute between its own act and Companies Act, then such companies will always and always follow own act. Let me give you one more example. A company called as LIC is again an example of a statutory company. Yes, LIC will follow own act as well as Companies Act 2013. But whenever there is a dispute between the provisions of own act and Companies Act 2013, then in that case, such companies will always and always follow the provisions of its own act. Sir, are such companies in existence in India? Yes, pretty obvious. There are so many companies which are considered to be a statutory company. For example, ICAI, ICSI, LIC, SBI, they are nothing but examples of a statutory companies. So yes, friends, we have also completed a provision towards statutory company. Now, in practical life, a common man, whenever wants to incorporate a company, then that common man is not in a position to incorporate a chartered company. In a similar way, a common man is also not in a position to incorporate a statutory company. So the option left out is nothing but a registered company. Under registered company, we have got five options. You can either incorporate a private company, or you can go for one person company, or you can go for a small company, or you can go for a public company, or you can go for a non-profit companies. First of all, let us understand the provisions towards private company. What do you mean by private company? The concept of private company is given under section number 2, clause 68. Yes, it is section number 2, clause 68, which defines the provisions towards a private company. A private company is a company wherein there are minimum 2 members. Yes, in a private company, there has to be minimum 2 members. Sir, who can become a member of a private company? Law says any person can become a member of a private company. In order to become a member, in order to become a member of a private company, you need to satisfy you need to satisfy nothing but either as a natural person or as an artificial person. So any person can become a member of a private company, irrespective whether the person is a natural person or an artificial person. Okay, the private company is managed by board of directors. So in a private company, law says there has to be minimum 2 board of directors, there has to be minimum 2 directors. So private company, minimum members 2, minimum directors 2. So who can become a director? Law says only and only a natural person can become a director of a private company. Sir, can an artificial person become a director of a company? Law says no. Sir, can an artificial person become a member of a company? Law says yes. So in a private company, there has to be minimum 2 persons, that is minimum 2 members, wherein the private company will be managed by minimum 2 directors. The name of such companies will always and always end with the words called as private limited. So the name of a private company will always and always end with the words called as private limited. Over here, whenever you talk about a private company, then yes, private company do have articles of association. Private company do have articles of association. Inside their articles of association, they need to have following rules. Rule number 1, in a private company, there cannot be more than 200 members. So in a private company, minimum members 2, maximum members 200. Minimum members 2, maximum members 200. Over here, whenever you are counting the list of these 200 members, then in that list, joint members will be counted as one. For example, I, Karthik and Aryan, we three came together and we have purchased the shares of a private company. All of us are members of the private company. We are joint members. Yes, we all are members. But while counting the list of 200 members, we three will be considered as one. So joint members will be considered as one. Over here, any shares, any securities given to an employee, whether that employee is a past employee or a present employee, and such securities were being given under ESOP, that is employee stock option plan, then such employee is considered as a member, but not to be included in the list of those 200 members. So in a private company, there are maximum 200 members, excluding the employees, whether past or present, whom the securities were given through ESOP, and joint members will be considered as one. The second rule inside the articles of a private company talks about restricts the transferability of shares. Yes, the shares of a private company are transferable in nature. The shares of a private company are transferable in nature. But there is a restriction upon that transfer, that it cannot be transferred to public at large. So are the shares of a private company transferable? The answer is yes, but there is a restriction for the same. There is a restriction for the same. The shares of a private company cannot be transferred. The shares of a private company cannot be transferred to public at large. The next rule says a private company is been prohibited. I use the word prohibited. Private company is been prohibited to issue securities to public at large. Being a private company, whenever you want to issue securities, you can issue securities, but such securities shall never be issued to public at large. In fact, a private company is also been prohibited to accept deposits from public at large. So, sir, can a private company issue securities? The answer is yes, but not to public at large. Sir, can a private company accept deposits? The answer is yes, but not from public at large. So, prohibits issue of securities to public at large and prohibits acceptance of deposits from public at large. So, friends, this was the concept towards private company. That is section number 2, clause 68. Once you understand the concept of a private company, then it becomes very much easy for you to understand the concept of a public company. Yes, friends, the concept of public company is given under section number 2, clause 71. So henceforth, whenever I'm going to use out the words called as public company, the very first thing which is going to run in your mind is section number 2, clause 71. Law says a public company is a company other than private company. It is a company other than private company, wherein there are minimum 7 members. Yes, wherein there are minimum 7 members. Sir, who can become a member of a public company? Law says any person can become a member of a public company. Any person can become a member of a public company, irrespective whether the person is a natural person or the person is an artificial person. So, if you want to become a member of a company, you need to be a person. You need to be a person, irrespective whether that person is a natural person or that person is an artificial person. Over here, in a public company, there has to be minimum 3 directors. In a public company, there has to be minimum 3 directors. Sir, who can become a director of a public company? Law says only and only a natural person can become a director of a public company. Sir, can artificial person become a director of a public company? Law says not possible. Sir, can an artificial person become a member of a public company? Law says yes, it's possible. It's allowed. The name of a public company should always and always end. The name of a public company should always and always end with the words called as limited. Sir, does a public company has got articles of association? Pretty obvious. Even public company has got articles of association. But the provisions which are present inside the articles of a private company, those provisions are not applicable inside the articles of a public company. Which means inside a public company articles, there is no such provision of maximum 200 members. The shares of a public company are freely transferable. A public company can easily issue securities to public at large, and yes, a public company can easily accept deposits from public at large. Whenever there is a public company who is holding a private company, public company holding a private company. So this is a private company, this is the holding company. See, this public company is holding a private company, which means private is the subsidiary and public is the holding. So whenever a public company is holding a private company, then that private company is deemed to be a public company, assumed to be a public company, but they will still follow the provisions of section number 2, clause 68. You are just been assumed to be a public company, but you are actually going to follow the provisions of private company, that is section 2, clause 68. So public company holding a private company, then that private company is deemed to be a public company. So friends, this was the provision towards the concept called as a public company. Now, what do you mean by a non-profit company? See, you have already studied this thing in your accounts. There is a concept called as a non-profit organization. Now we have to understand the same concept but in our legal languages. Non-profit companies are nothing but section 8 companies. So either you say non-profit company or you say section 8 companies, it remains one and the same. Law says that a non-profit company is a company which is formed either as a private company or it is formed either as a public company. So non-profit companies can either be a private company or it can either be a public company. If it is a private company, then they will follow the provisions of section number 2, clause 68. However, if it is a public company, then it will follow the provisions of section number 2, clause 71. Generally, the name of every companies is ending with the words called as private limited or with the words called as limited. However, this provision is not mandatory for a non-profit company. For them, it is completely optional. Why? Because it is a company which is getting formed not for doing business, not for generating profits, but the company has been formed for the benefits of the society. That's such a social activity they are going to do. Such a social activity they are going to do. The company is formed for the benefits of the society. Looking into this matter, the central government got touched. Central government said, oh, wow, you are a company which is not going to earn profit, but you are going to do some business for the benefits of the society. Whatever are your business activities, it will be done for the benefits of the society. For that reason, central government has given certain exemptions to a non-profit company. Certain exemptions from the provisions of Companies Act 2013 are given to a non-profit company. However, in order to enjoy such exemptions, certain conditions has to be fulfilled. Condition number 1, the company is formed to promote an activity towards commerce or science or arts or religion or sports or etc. So the company has to be formed. The company has to be formed to promote an activity towards commerce, science, arts, religion, sports, etc. Wherein condition number 2 says that the company is prohibited. The company is prohibited to distribute profits amongst its members. If first of all you are not going to generate profits here, but by chance, even if there is an unintentional profit, then that profit you should not distribute amongst your members. In that case, whatever is the unintentional profit, that profit should be reutilized for the same purpose for which the company was been incorporated. But you should not distribute that profits amongst your members. So these are the two conditions which are required to be fulfilled. Then only you are going to enjoy the exemptions from a Companies Act 2013. Whenever you want to do a business in a form of a non-profit company, then in that case, you require to get a license from central government. In order to get that license, the central government has imposed those conditions upon you. But if the provisions are not been fulfilled, then central government has got the power to revoke your license as well. So if central government has got the power to issue you the license, then the same central government also has the power to revoke your license. Whenever the central government will pass an order for the same, then in that case, if the public interest is getting affected, then central government may ask the non-profit company to get itself converted into any other form of a company and get its name changed and get the name changed. Or else central government may ask you to amalgamate with another non-profit company which is having the similar lines of business. Or else central government can also pass an order for liquidation of your company, that is winding up of your company. So yes, friends, this was the provision towards non-profit company. Let us understand the next provision, that is a small company. The word itself says small company. The concept of small company is given under section number 2, clause 85. So henceforth, whenever I'm going to use out the words called as a small company, the very first thing which is going to run in your mind is section number 2, clause 85. Law says small company is a company other than public company, which means every small company is a private company. They're other than public means they are nothing but a private companies. So sir, every small company is a private company? Yes. So sir, every private company is a small company? I never said that. I said every small company is a private company. Okay, so every small company is other than a public company. That is, they are nothing but in a private company. They are in the form of a private company. Wherein the paid up capital of a small company should not exceed 50 lakhs or any other amount not exceeding 10 crores. Generally, the paid up capital should be less than 50 lakhs. It should not exceed 50 lakhs. Then only you are a small company. However, there can be any other amount, but that amount should not exceed 10 crores. And the turnover of your company should not exceed 2 crores or any other amount not exceeding 100 crores. So paid up capital should be less than 50 lakhs and turnover should also be less than 2 crores. Then only you are considered to be a small company. Are you sure? Okay. Let us go on to the last provision on the basis of incorporation. That is a company called as a one-person company. The concept of one-person company is given under section number 2, clause 62. Yes, it is section number 2, clause 62 deals with one-person company. Law says one-person company is a company formed in the lines of a private company. So yes, again, every one-person company is nothing but a private company. Wherein inside that one-person company, there has to be one and only one person as the member of the company. And that person over here, that person has to be mandatorily a natural person. In fact, that natural person should be a resident of India, citizen of India. In a one-person company, there is minimum one director, which means there can be more than one director, but the member has to be one and only one. The name of a one-person company will be ending with the words called as private limited. But below its name, they need to put down the words called as one-person company inside a bracket. Yes, friends, the concept of one-person company was introduced in our country through a committee called as J.J. Irani Committee. It was J.J. Irani Committee who has brought this concept in our country called as one-person company. Generally, whenever you want to do a business in a form of a company, you require minimum 2 members. A lone person was not in a position to do a business in a form of a company. However, to eradicate this thing, the rule of one-person company was been introduced in our country. Now, whenever there is a one-person company, then in that company, a nominee will be appointed. And that nominee should also be a natural person, resident of India, citizen of India. Over here, the moment the original member dies, the nominee will start acting as the member of that one-person company. Either you can be a member of a OPC or you can be a nominee of an OPC. Over here, a minor is not allowed to act either as a member of an OPC or a minor is also not allowed to also act as a nominee of an OPC. Whenever you talk about one-person company, then in that case, in order to avoid compulsory conversion, your paid up capital should be less than 50 lakhs or your average turnover of last 3 years should be less than 2 crores. If any one of the conditions are not been fulfilled, then sorry to say, you cease to be a one-person company and there will be a compulsory conversion of your one-person company either into private company or into a public company. Sir, can a one-person company voluntarily get converted either into private company or public company? Law says yes, but only after the expiry of 2 years from the date of incorporation. The procedure of conversion is not there in your CA foundation level. That we will be discussing. We will be discussing it under section number 18 of Companies Act 2013, and that will be done in our inter-CA level, So friends, this was the list of companies on the basis of incorporation. Let us move on to the companies on the basis of liability. On the basis of liability, we have got company limited by shares, company limited by guarantee, and companies having unlimited liability. Generally, friends, whenever you talk about the liability of a member in a company, then yes, the liability of a member in a company is limited in nature. But wait. Now, when I say that on the basis of liability, we have got 3 different types of companies, then in that case, if I'm going to ask you, what is the liability of a member in a company, then your answer has to be the liability of a member in a company depends upon the type of company it is. The liability of a member in a company depends upon the type of company it is. If you are a member in a company limited by shares, then the provisions of section number 2 clause 22 gets applicable, and as per that provision, the liability of such members is limited only and only up to the unpaid value of shares. If the shares are fully paid up, then there is no liability. So if you are a member in a company limited by shares, point number one, your liability is limited. That is only to the extent of unpaid value of shares. However, if the shares are fully paid up, there is no liability. Okay. What if you are a member in a company limited by guarantee? That is section number 2, clause 21. If you are a member in a company limited by guarantee, then in that case, the liability of the member is again limited, but only and only up to the amount given inside the memorandum of association of that company. And that amount the company will call up at the time of liquidation. So, if at the time of liquidation the company is not in a position to pay off its liabilities against the assets available, then every member has given a particular guarantee, and that amount will be specified inside the MOA, and that is the maximum liability the member will have to pay. However, if that company is also having a share capital, then in that case, the liability of such members will be two-folded. One, towards the guaranteed amount given inside the memorandum, and second, towards the unpaid value of shares, if any. Last, if you are a member in a company having unlimited liability, see, practically, I have not seen such companies. But there is a provision, so we need to understand it. So, if at all you are a member in a company having unlimited liability, then in that case, the liability of every member is as per section number 2, clause 92. Yes, the concept of unlimited liability is given under section number 2, clause 92. Over here, in such a case, the liability of every member is unlimited. The liability of every member is unlimited, which means even the personal assets of the members will be held responsible to pay off the liabilities of the company. So if the company is not in a position to pay off their liabilities, then the member will have to sell off their personal assets and pay the liabilities of the company. But wait. In this case, the members are not directly liable to the creditors. The members are not directly liable to the creditors. The members are liable to the company, and the company is liable to the creditors. However, if that company is having a share capital as well, then in that case, the liabilities of that member will be two-folded. That is, one, towards the unlimited portion, and second, towards the unpaid value of shares, if any. So yes, friends, we have also completed companies on the basis of liability. Let us go on to the last basis, that is companies on the basis of control. On the basis of control, we have got a government company, foreign company, holding and subsidiary company. When I talk about a government company, yes, the concept of government company is given under section number 2, clause 45. So henceforth, whenever I'm going to talk about government company, the very first thing which is going to run in your mind is section number 2, clause 45. Section number 2, clause 45. It is a company wherein 51% or more of the paid up capital, which is replaced with the words called as total voting power. 51% or more of the paid up capital, which is replaced with the words called as total voting power, is held either by central government or by state government, or partly by central government, partly by state government. then such companies are nothing but a government company. Example, ONGC, wherein more than 51% of the paid up capital, that is the total voting power, is held either by central government or by state government, or partly by central government, partly by state government. Whatever are the shares held by central government, then those shares are held in the name of President of India. Whatever are the shares held by the state government, then those shares are held in the name of concerned state governor. So friends, that was the concept towards a government company. Let us go on further towards a very small provision, that is a foreign company. What do you mean by a foreign company? The concept of foreign company is given under section number 2, clause 42. Yes, it is section number 2, clause 42, which deals with foreign company. Foreign company is a company which is incorporated outside India. Foreign company is a company which is incorporated outside India, but they are having a place of business in India. They are having a place of business in India. So any company which is incorporated outside India, but if they are having a place of business in India, then those companies are called as a foreign company. The best example over here is Samsung, Microsoft, Apple, McDonald's, Pizza Hut, Domino's. All of them are nothing but foreign companies, because they are the companies which are incorporated outside India, but they are having a place of business in India. The last concept over here on the basis of control is about holding and subsidiary companies. See friends, the concept of holding company is given under section number 2, clause 46. Whereas the concept of a subsidiary company is given under section number 2, clause 87. Let us discuss subsidiary company so that automatically we will be understanding the concept of a holding company. Yes, friends, law says a subsidiary company is a company wherein another company has got majority into the composition of the board of directors. If inside your company, the majority of the board of directors are representing another company, then that another company is the holding company and you are acting its subsidiary company. So if inside your company, the majority of the directors are representing another company, then you are subsidiary, and the company which has got majority of directors is a holding company. Or else, subsidiary company is a company wherein another company has got majority into the total voting power. Inside your company, if there is another company called as X company, that X company has got majority of total voting power, which means X is the holding company and your company is the subsidiary company. When I talk about total voting power, I am talking about voting powers towards equity shareholders along with convertible preference shareholders. So if another company has got a majority into the total voting power, then that company which has got the majority is the holding company and yours is nothing but the subsidiary company. Okay. Kunal Shah Limited is a holding company of Reliance. So when I say Kunal Shah is the holding and Reliance is my subsidiary. But now Reliance itself is acting as holding company of another company called as Tata Sons Limited. Then the relation between Reliance and Tata is holding and subsidiary. Wherein Reliance is the holding, Tata is the subsidiary. But Reliance, you yourself is a subsidiary of Kunal Shah Limited. So Kunal Shah is nothing but holding of Reliance, and Kunal Shah is also indirectly the holding of Tata Sons Limited. Are you all getting me or not? Over here, over here. This was the concept towards holding and subsidiary companies. However, friends, we have got few more things, that is other forms of companies. That is a concept called as an associate company, dormant companies, public financial institutions, nidhi companies, listed companies, unlisted companies. Let us first of all discuss associate companies. What do you mean by associate companies? Law says, law says associate company is a company other than subsidiary company. So first of all, they are not in the nature of holding and subsidiary. First of all, they are not in the nature of holding and subsidiary companies. So associate company is a company other than subsidiary company wherein another company has got a significant influence. What is a significant influence? Significant influence means another company is having a control which is more than equal to 20%. So any company which has got a significant influence over your company, then yes, there is a concept of associate company. If my company has got a control inside your company which is of 35%, then yes, you are my associate companies. So associate company is a company wherein another company has got a significant influence, and significant influence talks about a control which is more than equal to 20%. It is more than equal to 20%, but less than 50%. Less than 50%. If it is more than 50%, then automatically you are a subsidiary company. Na? But law itself says that associate company is other than subsidiary company. So wherein another company has got a significant influence, which is an influence which is more than equal to 20%, but less than 50%. Next is nothing but a dormant company. Friends, dormant company is actually nothing but the status of a company. See, every company will be having a status. The status will either be called as an active company or the status will be a dormant company. Matlab inactive company. It's an inactive company. The company has already been incorporated, but the company has got a status of inactive. Then they are called as dormant companies. Which means the company has not incurred significant accounting transactions. The company is already been incorporated. The company is already been incorporated, but the company has not entered into significant accounting transactions. Then yes, those companies are called as dormant companies. In short, they are inactive companies. Public financial institutions, that is LIC, UTI, IDFCs, they are nothing but public financial institutions. The same thing is given inside the definition of a public financial institution, that is LIC, IDFC, UTI, etc. Nidhi companies, at your foundation level and at your inter-CA level, you are just having the definition towards Nidhi companies, but at your final CA level, you will be having a full-fledged chapter called as Nidhi companies itself. See, Nidhi company is a company incorporated as a Nidhi. It is a company incorporated as Nidhi. Nidhi means treasure. So any company incorporated as Nidhi under Companies Act 2013 are called as Nidhi companies. Such companies will inculcate an habit of cost cutting amongst their members. So whoever are the members of a Nidhi company will always and always be having a habit of cost cutting. Cut the cost, save the money, invest that money into the Nidhi company. And now that Nidhi company will facilitate financial help only and only to the members of the company. So Nidhi company is a company incorporated as a Nidhi under the provisions of Companies Act 2013, wherein the members of such companies will be inculcating a habit of cost cutting amongst themselves. Such companies will provide financial assistance only and only to their members. Yes, friends, Nidhi companies are also called as mutual benefit society. Nidhi companies are also called as mutual benefit societies. Next concept over here is about listed companies. What do you mean by listed companies? Any companies whose securities are being listed under a recognized stock exchange. Reliance Industries Limited. See, their securities are listed under a stock exchange called as Bombay Stock Exchange and National Stock Exchange. So Reliance is nothing but an example of listed companies. So any companies whose securities are listed, under a recognized stock exchange, then those companies are called as listed companies. Other than listed companies are nothing but unlisted companies. Generally, private companies are unlisted companies. Okay, public company who has given their securities to public at large are listed companies. But there are few public companies who have not given their securities to public at large. Then those public companies are still public companies but considered to be unlisted because they have never gone for a public offer. So, friends, with this, we have completed one of the concept, that is classification of companies. Let us go on to another concept which talks about promoter and incorporation of a company. Promoter and incorporation of a company. Let us first have a discussion towards part A, promoter of a company. What do you mean by promoter? Promoter means any person who conceives the idea of doing a business in a form of a company. The person who conceived the idea of doing a business in a form of a company, then that person is nothing but promoter of that company. Reliance Industries Limited. The idea of doing a business in form of Reliance Industries Limited was conceived by Honorable Shri Dhirubhai Ambani. So can I say Dhirubhai Ambani is nothing but promoter of Reliance Industries Limited? Yes, because it was he who conceived the idea of doing a business in a form of Reliance Industries Limited. So any person who conceives the idea of doing a business in a form of a company, then that person is nothing but the promoter of the company. That person is nothing but the promoter of the company. In a similar way, if you take an example of Microsoft, it was Mr. Bill Gates who conceived the idea of doing the business in a form of a company called as Microsoft. So, friends, promoter means what? Promoter means any person who conceives the idea of doing a business in a form of a company. Once he has conceived the idea, then he will not sleep. He will not sleep until he has conceived the idea of doing a business in a form of a company. Once he has conceived the idea of doing a business in a form of a company, then that person is nothing but the promoter of that company. So sorry, friends. I guess there was a glitch in between. Just give me a minute, friends. Just give me a minute. Okay. I guess there was a small glitch. There was an audio problem at the time of promoters of a company. So I'll just repeat the concept towards the promoters of a company. Friends, promoter is a person who conceives the idea of doing a business in a form of a company. Any person who conceives the idea of doing a business in a form of a company, then that person is considered to be a promoter of a company. If you take an example of Reliance Industries Limited, yes, it was Dhirubhai Ambani who conceived the idea of doing business in a form of Reliance Industries Limited. So Dhirubhai Ambani is nothing but the promoter of Reliance Industries Limited. In a similar way, if you talk about Microsoft, then yes, friends, Microsoft is nothing but the idea conceived by Bill Gates. So any person who conceives the idea of doing a business in a form of a company, that person is considered to be the promoter of the company. Once the promoter conceives the idea of doing a business in a form of a company, later on that person actually forms the company, means brings the company into existence. That person brings the company into existence. Sir, how is that person bringing the company into existence? In that case, it is the promoter who fulfills the provision of section number 7. What is section number 7? Incorporation of a company. There's a procedure given for incorporation of a company. Yes, it is the promoter who fulfills that procedure. It is the promoter who fulfills that procedure. Sir, is it mandatory to incorporate a company? Yes. Yes, if you don't incorporate your company, then in the eyes of law, sorry to say, your company is an illegal association. So it is the promoter who gets the company incorporated. Once the company has been incorporated, the entire company functions as per a document called as Memorandum of Association and Articles of Association. These are the two fundamental documents as per which the company functions. Yes, friends, to run a partnership, can I say we require a partnership deed? So in a similar way, to run a company, we require a document called as Memorandum of Association and Articles of Association. Yes, both of these documents are actually being prepared by the promoters of the company. Over here, generally, the management of the company, that is the directors of the company, are being appointed by the members of the company. It is the members who appoints the directors. But the first directors of the company are being appointed by the promoters of the company. For example, a company is getting incorporated at morning 10 o'clock, which means at morning 10:01, the company requires a manager. Generally, the manager is appointed by the members of the company. But how is it possible that within 1 minute the company will issue shares? And within that 1 minute, the members will get appointed. The members will later on appoint something called as the directors, and those persons will manage the company. Is entire process going to get completed within 1 minute? No, not possible. So in that case, the powers are being given to the promoters to appoint the first directors of the company. The subsequent directors will be appointed by the members, but the first directors of the company are always and always appointed by the promoters of the company. I said about the first directors. Huh? I never talked about one director. I said about the first directors. If it is a private company, then yes, there will be minimum 2 directors appointed as the first directors. When I say about a public company, then yes, there will be minimum 3 directors appointed as the first directors, and they are the directors appointed by the promoters of the company. Even before the company comes into existence, there are certain contracts which are required to be entered. Those contracts are called as preliminary contracts. That is pre-incorporation contracts. Pre-incorporation contracts. Those pre-incorporation contracts, those preliminary contracts are entered by the promoters of the company because the company has not yet come into existence. Yes, it is the promoter who has got a real interest into the business of the company. It is the promoter who has got a real interest into the business of the company. If you talk about Dhirubhai Ambani, if you talk about Kunal Shah, I invested my money with Reliance. Even Dhirubhai Ambani invested his money with Reliance. But who is the person who has got real interest into the business of the company? Yes, it is Dhirubhai Ambani who has got a real interest into the business of the company. So Dhirubhai Ambani is nothing but the promoter of Reliance Industries Limited. Yes, friends, law says promoter is neither an agent nor a trustee. See, when can you term yourself as an agent? You can term yourself as an agent only when there is a principal above you. If promoter is the agent, that company has to act as a principal, but the company has not yet come into existence. If there is no principal, how can there be a question of an agent? So promoter is neither an agent. If you talk about a trustee, then a person is acting as a trustee for some kind of a trust. The company has not yet incorporated, then how can there be a trustee? If there is no trust been incorporated, then how can there be a trustee for a trust? So promoter is neither an agent nor a trustee, but he acts like an agent, he acts like a trustee. He's actually not an agent, he's actually not a trustee, but he's acting like an agent, he's acting like a trustee. Over here, let us understand the definition of the word called as promoter. The word promoter is actually defined under section number 2, clause 69. Yes, it is section number 2, clause 69, which defines promoters. Law says promoter means any person whose name is given inside the prospectus of a company as such, or your name has been identified inside the annual return of a company. So if your name is there inside the prospectus of a company as a promoter, you are a promoter. Or else your name has been identified by the company inside the annual return as a promoter, then yes, you are a promoter of that company. Or else any person having a direct control over the affairs of the company or having an indirect control over the affairs of the company. Any person having either a direct control over the affairs of the company or having an indirect control over the affairs of the company, then even those are the persons considered to be the promoters of the company. Right now, Reliance Industries Limited is under the direct control of Mukesh Ambani. So can I say Mukesh Ambani is promoter of Reliance Industries Limited because Reliance Industries Limited is directly been controlled. The affairs of the company are under the direct control of Mr. Mukesh Ambani. So either you are having a direct control or you are having an indirect control over the affairs of the company, then yes, even in that case, you are considered to be the promoter of the company. Or else any person in whose advice or in whose directions the board of directors are accustomed to act. Accustomed means compulsory to act. You are a person in whose advice the board of directors are always and always compulsorily to act. The board of directors have to work as per your advice. Then again, who are you? You are promoter of a company. If you take an example of Tata Sons Limited, in the year of 2012, Ratan Tata said, I want to retire from the company. None of the board of directors gave an argument. Board of directors said, okay, sir, as you wish. Later on, Ratan Tata said, after my retirement, I believe the entire company will be managed by Cyrus Mistry. None of the board of directors raised a complaint. Everyone said, okay, sir, as you wish. After 4-5 years, Ratan Tata said, no, 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 Mistry, go back, Mistry, go back. All the board of directors said, okay, sir, as you wish. So, the board of directors of Tata Sons Limited are compulsorily been asked to act as per the directions given by Ratan Tata. So, Ratan Tata is nothing but promoter of Tata Sons Limited. One fine day, I was acting as a statutory auditor for Reliance Industries Limited. See, the statutory auditor is a very, very, very powerful person. One fine day, I said to the management of the company, your books of accounts are not being properly maintained. Please maintain it properly, otherwise I will qualify my audit report. The moment I say qualify my audit report, the management of the company are being frightened with fear. Over here, they are bound to do as per my advice. But that does not mean that I'm a promoter of Reliance because the advice given by me is under a professional capacity. Just note down the note. Note down the note given over here. If the directions or advice are given under professional capacity, then such persons are excluded from the list of promoters. So this was nothing but the definition of the word called as promoters. Are you all sure, friends? Yes, friends, we'll go for a break for 5 minutes, and after 5 minutes, we will start again with our part B, that is procedure for incorporation of a company. Thank you so much. Yes, friends, welcome back to the world of business law. Before the break, we had started a topic called as promoters of the company and incorporation of a company. Wherein, friends, we have successfully completed part A, that was promoters of a company. Now, friends, let us go on to part B, which talks about the procedure for incorporation of a company. First of all, is it mandatory to incorporate a company? Law says yes, it is mandatory to incorporate a company. If the company is not incorporated, then in the eyes of law, it is nothing but an illegal association. So, yes, incorporation of a company is mandatory. The entire procedure for incorporation is given under section number 7 of Companies Act 2013. Wherein the very first step towards section number 7 talks about selecting the type of a company, which company you want to incorporate. So select the type of a company which you want to incorporate. For example, let us incorporate a company which is a public company, wherein on the basis of liability the company is limited by shares, and on the basis of control the company is a non-government company, which means majority of the shares are not held by central government or by state government, or partly by central government, partly by state government. So we are having a plan to incorporate a public company limited by shares, having no government control. So friends, that was step number 1, selecting the type of a company. Once you have completed step number 1, then we have to go for step number 2, which talks about preliminary requirements. What are preliminary requirements? Primary requirements. Primary requirements. Yes. Over here, there are two primary requirements. One is DIN, another is DSC. When I say DIN, it is talking about Director's Identification Number, which is of 8 digits. DIN is of 8 digits. Law says every director of a company must have a dean. No dean, no directorship. No dean, no directorship. Sir, how many dean a director can have? Law says one director, one dean. One director, one dean. No dean, no directorship. Wherein dean is nothing but of 8-digit numbers. How many PAN cards you have? One. How many passports you have? One. How many Aadhaar cards you can have? One. So in a similar way, a director of a company can only have one dean. One director, one dean. No dean, no directorship. If you don't have a dean, then apply for the dean. Apply for the dean, that is director's identification number. Then only you can be appointed as the director of a company. Now talks about digital signature certificate. Law says at least one of the director, at least one of the director must have a digital signature certificate. At least one of the director must have a digital signature certificate. Dean should be there with every director. Digital signature certificate should be there with at least one of the director. So that was just step number 2. Sir, what is the requirement of having digital signature certificate? See, the working of ROC, that is Register of Companies, previously was under a format called as physical submission of forms, physical signing of forms. But, but now the working of an ROC is being done under an electronic form, wherein the various forms which we have to fill up is electronic forms. The signatures required over there are electronic signatures, that are digital signatures. So law says at least one of the director, at least one of the director must have a digital signature certificate. So step number 1 was selecting the type of a company. Step number 2 was towards preliminary requirements. Step number 3, reservation of the name of the company. Whenever the company gets incorporated, that company gets its own separate legal identity. The company gets its own separate legal existence. The company gets its own separate legal personality, which means the company requires its unique name. A company requires a unique name. For that case, we need to reserve a unique name. In that case, we need to file a form called as e-form RUN. E-form means electronic form. RUN stands for reserve unique name, wherein under this electronic form the promoters can provide maximum 6 names in preferential order. Promoters can say to the ROC officers that this is our preferential order. If this name is available, give us this name. If this name is not available, then this. If not that, then this. If not that, then this. So 6 names can be given in a preferential order, maximum 6 names, wherein the fees for filing the same is 1,000 rupees. So step number 3, we have to reserve a unique name for our company. Whenever you are reserving a unique name for your company, always and always remember, you cannot reserve a name which is already an existing name. Right now, you cannot incorporate a company called as Reliance Industries Limited. No, not allowed, because this name is already been used by another company. So you are not allowed to reserve a name which is already an existing name of a company. In a similar way, you cannot apply for a name which is a misleading name. The company is having a business of automobiles, but at the end of the name you are writing down something called as Solar Power Limited. You are dealing with automobiles, and how can you say Solar Power in the name of your company? So the name should not be a misleading names. Third, the name should not be an undesirable name. You should not use any kind of slang words inside the name of your company. So we have to follow this rule, and we have to reserve a unique name for our company under step number 3. So step number 1, select the type of a company which you want to incorporate. Step number 2, go for preliminary requirements. That is number 1, DIN, and number 2, DSC. Step number 3, reservation of a unique name of the company. Once you have completed step number 3, then step number 4 says we have to prepare memorandum of association and articles of association. Both of these documents are being prepared by the promoters of the company. However, this document will be prepared as per schedule number 1 of Companies Act 2013. Yes, schedule number 1 of Companies Act 2013 is utilized for the preparation of MOA and AOA. Inside schedule number 1, there are 10 tables. Out of these 10 tables, the first 5 tables, that is table A, B, C, D, and E, these are the 5 tables utilized for the preparation of MOA, whereas table number F, G, H, I, and J are utilized for the preparation of AOA. So step number 4, we have to prepare the fundamental documents of the company, that is MOA and AOA. And these documents will be prepared as per schedule number 1. And under schedule number 1, there are total 10 tables. Out of these 10 tables, the first 5 tables are utilized for the preparation of MOA, whereas last 5 tables are utilized for the preparation of AOA. Once you have completed step number 4, then we can go for step number 5. Step number 5 talks about filing of documents. Step number 5 talks about filing of documents. We need to file certain documents to the office of registrar. The very first thing we require to file over here is the application form for incorporation of a company. Application form can either be a form called as INC2, or it can either be a form called as INC7. Depending upon the type of a company, we need to apply. If we are a one-person company, then the application for incorporation will be given under INC2, wherein INC stands for incorporation, form number 2. Our is a public company, so can I say it is other than one-person company? So we need to apply under a form called as INC7, that is an application form for incorporation of a company other than one-person company. Along with the application form, we need to file the list of documents. Yes, all these documents are mandatory in nature, except the last one. The last one, which is INC 22, it is optional. The last one, that is INC 22, is optional. However, that last document, INC 22, is optional only for the time being. It is optional only at the time of incorporation. Once the company is incorporated, then yes, it is required, it is mandatory to file INC 22. So at the time of incorporation, INC 22 is optional, other all documents are mandatory. But once the company is incorporated, then after that, INC 22 also becomes mandatory in nature. INC 22 is something called as verification of registered office address. So let us first discuss the documents which are mandatory to be filed. The very first document we require to file is Memorandum of Association and Articles of Association. The copy of MOA and the copy of AOA will be filed to the registrar. So the registrar comes to know what are the objects of the company and how those objects are going to get achieved. The next document we have to file is INC 8, which is nothing but declaration. Declaration to be given by the first directors of the company along with a professional person who is in practice. A professional person can either be a chartered accountant or a company secretary or a legal advisor or a cost accountant. Any one out of them, but who has to be in a practice. So INC 8 is a declaration given by first directors along with a professional person who is under a practice, wherein they are going to declare that the company which is going to get incorporated is getting incorporated as per the provisions of Companies Act 2013. So that is just a mere declaration given by the first directors along with a professional person who is in a practice. The next form we require to file is INC 9, which is nothing but in the nature of an affidavit. INC 9 will be filed by the first directors of the company along with the subscribers to the MOA. See, every company has got a document called as Memorandum of Association. That Memorandum of Association should be subscribed. The persons who are going to subscribe it are called as subscribers. In case of a private company, minimum 2 subscribers are required. And in case of a public company, minimum 7 subscribers are required. These subscribers are considered as subscribers before incorporation. After incorporation, they are considered as the first members of the company. So INC 9 will be filed up by the first directors along with the subscribers of the MOA, wherein they are going to give an affidavit that we have not done fraud since last 5 years, and right now also we are not doing any kind of fraud. Such affidavit will be given under a form called as INC 9. After that, you have to also give an address for correspondence. You can tell to the ROC that the company is not yet incorporated, hence we don't have a registered office. So whatever is the correspondence you want to do with us, kindly correspond us at this address. This is the address for correspondence. The next thing we need to file is about the details of the subscribers. The persons who had subscribed to the memorandum are called as subscribers. We need to give their details, their name, their addresses, their citizenship, etc. All such details we need to provide to the registrar. The last thing we need to submit is the form called as DIR 12. DIR stands for directors. So under this form, we need to file the details of the first directors of the company. And all these documents will be filed with the ROC. The last one, INC 22, is completely optional. It is optional at the time of incorporation. After incorporation, it is mandatory because INC 22 deals with verification of registered office address. When all these documents are being filed to the registrar will check these documents, inspect these documents. The moment the registrar is been satisfied, the registrar will issue you a certificate of incorporation under step number 6. However, along with certificate of incorporation, the registrar also issues a corporate identification number, which is roughly called as CIN, CIN, which is of 21 digits. Henceforth, the company is not known by its name. The company will be recognized by its CIN, that is corporate identification number. This certificate of incorporation itself is a conclusive evidence. This certificate of incorporation itself is the conclusive evidence that the company is incorporated. No one can challenge this document. Once this certificate is issued, even ROC does not have the power to cancel this certificate. Once it is issued forever. But wait. If the company is been caught of doing some kind of illegal activities, then yes, the registrar has got the power. The registrar has got the power to strike off the name of the company from the list of registered company, which means now onwards you are no more a company. Now onwards you are no more a company. So once the certificate is issued, no one can challenge this certificate. Now onwards, if the company is been caught of doing some kind of illegal activities, then yes, the registrar has got the power to strike off the name of the company from the list of registered company. Last point, that is step number 7, which talks about effect of incorporation. What is the effect of a company getting incorporated? Whenever a company gets incorporated, the very first effect is towards separate legal entity. The company will start enjoying perpetual succession. There will be separation of ownership and management. Yes, the company will be having the members of the company will be having a limited liability. What are all these things? They are nothing but characteristics of a company. And all these characteristics a company can use only and only when it is incorporated. So these are nothing but the effects of incorporation. So with this, friends, we have completed the entire procedure for incorporation of a company. Let us go on to the next part. The last part rather, that is the provision towards memorandum of association and articles of association. And along with this provision, we are also going to discuss 3 important doctrines, that is doctrine of constructive notice, doctrine of indoor management, and doctrine of ultra vires. Let us first discuss the concept towards memorandum of association. Law says that memorandum of association is a fundamental document without which a company cannot get incorporated. Yes, without memorandum of association, your company can never ever get incorporated. See, right now only, we have understood the entire procedure for incorporation of a company. The entire procedure was given under section number 7. In that section number 7, can I say step number 4 said prepare MO and AOA. Then under step number 5, we had to submit the copy of MO and AOA to the ROC, and then under step number 6, the company was getting incorporated. So memorandum of association is also a fundamental document. Articles of association is also a fundamental document. Without them, the company can never ever get incorporated. Without that, a company can never get incorporated. In fact, memorandum of association is considered as a charter of a company. It is considered as a charter. Charter stands for constitution. To run a country, we require a constitution. Similarly, to run a company, we require memorandum of association. So memorandum of association is considered as a charter for a company. In fact, memorandum of association talks about the contractual capacity of a company, which means what? Can a company enter into a contract? Yes, company is an artificial person, and being an artificial person, yes, they can enter into a contract. In order to enter into a contract, the company must be qualified by law, which means the company can enter only those contracts which are allowed by its memorandum of association. So memorandum of association is considered as a charter, and it also defines the contractual capacity for a company. In fact, inside the memorandum of association, we have to explain what a company can do, what are the objects of the company. Such objects can either be in an affirmative way or it can also be in a negative way. The objects of a company can either be in an affirmative way or it can also be in a negative way. If it is affirmative, means it is positive. We have just said inside the memorandum that our company can do a business of insurance. It is affirmative. We can do a business of insurance. I said inside the memorandum, our company will never deal with educational sector. It is negative in nature. We will never deal with educational sectors. So the objects of the company can either be affirmative in nature or it can also be negative in nature. If it is affirmative, then yes, along with the object, we also need to define the scope, the limit up to which it is affirmative. When I said that the company can do a business of insurance, then I will also define the limit of insurance. I will also define the scope that insurance for us means life insurance only, which means fire insurance and marine insurance are negative for us. So when the objects are affirmative, then along with the objects, we also need to define the scope, the limit up to which it is positive. Beyond that, it is negative. However, if the objects are negatively defined, then in that case, we don't need to define the scope because the things which are negative are completely negative. When I said that the company will never ever enter into educational contracts, I don't need to define the scope now. Because when I said that we are never ever going to enter into educational contracts, it's simple. It's simple. It's so simple. We will never do a business towards educational sector. Now I don't need to define the scope up to this limit we cannot do. No. No means no. Complete no. So if the objects are affirmative in nature, we need to define the scope. Up to that limit it is positive. Beyond that it is negative. However, if the objects are negative in nature, then in that case, we don't need to define the scope because the things which are negative are completely negative. Let us go on to the next part, which talks about the definition of the word called as memorandum of association. Yes, friends, the word memorandum of association is defined under section number 2, clause 56. So henceforth, whenever I'm going to talk about a word called as memorandum, the very first thing which is going to run in your mind is section number 2, clause 56. Section number 2, clause 56 says memorandum means memorandum of association. That's so funny, man. Memorandum means memorandum of association of a company as originally framed or altered from time to time as per the provisions of previous Companies Act or as per this act, that is Companies Act 2013. Means what? Reliance Industries Limited had prepared their memorandum of association. It was originally framed as per Companies Act 1956. Till date, it is considered as memorandum of association. Acha, previously, if they had altered it, then that alteration would also be done as per Companies Act 1956. But till date, it is considered as memorandum of association. Today, if Reliance Industries Limited wants to alter their memorandum, they are allowed to alter it. But the procedure has to be done as per Companies Act 2013. And once the procedure is done, then even that altered copy of MOA will be considered as MOA itself. So the definition itself has given a power to alter the memorandum. However, how to alter the things, we will study in our inter-CA level. So if at all you come to a question that, sir, can a company alter its memorandum of association? The answer is yes. But how? That we are going to study at our inter-CA level. So yes, friends, memorandum of association can either be originally framed or it can be altered from time to time as per the provisions of Companies Act 2013 or as per any other previous law related towards company. So what is the purpose of having the memorandum of association? The purpose is twofolded. One, it is for the prospective shareholders. See, when I say prospective, it means future shareholders. Any person who wants to become the shareholder of your company, before investing his money in your company, he would like to know what this company is doing, and he will get the answer about what the company is doing through a document called as memorandum of association. So the very first purpose of having a memorandum of association is for the prospective shareholders. The second purpose for which we are having a memorandum of association is for the outsiders or the creditors. Whenever outsiders or creditors wants to enter into a contract, before entering into a contract, they would like to know whether the company is having a contractual capacity or not. And they will get this answer only through a document called as Memorandum of Association. So, the purpose of having a Memorandum of Association is twofolded. One is towards the prospective shareholders, and the second one is towards the outsiders or the creditors. Over here, can I say we need to form our Memorandum of Association? And yes, Memorandum of Association will be formed as per a schedule called as Schedule number 1. It will be formed as per a schedule called as Schedule number 1. Few minutes back, I told you that whenever we want to prepare Memorandum of Association and Articles of Association, then yes, these documents will be prepared as per Schedule number 1. Schedule number 1 comprises of 10 tables. Out of these 10 tables, first 5 tables are utilized for the preparation of MOA. That is table A, B, C, D, and E. Whereas table number F, G, H, I, and J are utilized for the preparation of Articles of Association. Let us first prepare Memorandum of Association. For that, we can take the help of table A, B, C, D, and E. Sir, we can select any table as per our own wish. No, you have to select the table depending upon the type of company you want to incorporate. Table A will be utilized by the company limited by shares. Table B will be utilized by the company limited by guarantee having no share capital. However, if you are a company limited by guarantee having share capital, then the memorandum of your company will be prepared as per table number C. Company having unlimited liability, having no share capital, they will prepare their memorandum as per table number D. Whereas there is a company having an unlimited liability, having share capital, they will prepare their memorandum as per table number E. So depending upon the type of a company, the table will be selected. See, we wanted to incorporate a public company limited by shares, na? So we will be forming our MOA as per table number A. That is for companies limited by shares. Once the MOA has been formed, then law says MOA should be in a printed form. It should be paragraphed. Everything should be numbered. It should be subscribed and it should be witnessed. The MOA should be in a printed form, paragraph form. Every paragraph should be numbered. Yes, it should be subscribed, and yes, it also should be witnessed. MOA has to be in a printed form, no? So that any outsider who wants to have a look upon the memorandum, we can easily give him a copy of MOA, and he can have a look upon the MOA. So MOA has to be in a printed form, wherein every content should be in a paragraph form. Every paragraph should also be numbered. It becomes easy for a person to read that document. MOA should be subscribed. Yes, in case of a private company, minimum 2 subscribers. In case of a public company, minimum 7 subscribers. They are the subscribers before incorporation. Once the company gets incorporated, then all those subscribers are acting as the members of the company. Yes, even a memorandum has to get witnessed. That yes, following persons who have subscribed it, they have subscribed it in front of me. I'm acting as a witness, so it has to be witnessed. So MOA should be in a printed form, paragraph form. Every paragraph should be numbered, it should be subscribed, and it should be witnessed. Sir, what are the contents of the Memorandum of Association? Inside a Memorandum of Association, these are the minimum contents you will come across. These are the minimum contents. There is name clause, situation clause, object clause, liability clause, capital clause, subscription clause, succession clause. I said these are the minimum content which you are coming across the memorandum of a company. There can be something which is extra over this, but there can nothing be lesser than this. There can be something which is more than this, but there should be nothing lesser than this. The very first clause inside the memorandum of a company talks about the name clause. What is a name clause? Inside this clause, we have to just write down the name of the company which we had reserved under step number 3 at the time of incorporation of a company under section number 7 of Companies Act 2013. Just few minutes back, I told you that whenever you want to incorporate a company, then we have to follow the procedure given under section number 7. And under section number 7, step number 3 says reserve the name of a company. Once the name has been reserved, step number 4, prepare MOA and UA. Whatever name we reserved, that name we have to put inside the name clause. So name clause talks about the name of the company. In order to get a name, your name should be a very unique name. You cannot keep the name of a company which is already an existing name. You cannot keep the name of a company which is misleading in nature. You cannot keep the name of a company which is undesirable words. So there are certain rules which are required to be followed whenever you want to reserve the name of a company. So name clause talks about the name of the company, the name which you have reserved under step number 3 of section number 7. The second clause is about the situation clause, also called as registered office clause. So it is mandatory for a company to have a registered office. At the time of incorporation, it is optional. But once the company is incorporated, then yes, it is mandatory for a company to have a registered office. Sir, what is a registered office? Yes, friends, registered office defines the jurisdiction of the company. Reliance Industries Limited is having the registered office in the state of Maharashtra, which means Reliance Industries Limited is coming under the jurisdiction of Maharashtra state government. To be more precise, Reliance is having the registered office in the city called as Mumbai. So whenever the Reliance company is going to call their annual general meeting, that annual general meeting will be called at that office in Mumbai or any other place within the same city, that is Mumbai itself. So every company must have a registered office. At the time of incorporation, it is optional. But once the company is incorporated, then yes, it is mandatory to have a registered office. But when I say registered office clause, when I say situation clause, then inside this clause, we have to just write down the name of the state. We have to just write down the name of the state where the registered office of the company is going to be situated. No need to write down the entire registered office address. Just write down the name of the state where the company is going to have its registered office. The next clause is about the object clause, which is one of the biggest clause inside the memorandum of a company. Yes, you can have a look inside the memorandum of any company you want to have a look. You can have a look inside the memorandum of any company. Inside the memorandum, the biggest clause, the lengthiest one, is the object clause. It is the object clause which defines the various objects of the company, what a company can do. Such objects, if are affirmative, then we also need to define the scope. If they are negative, we don't need to define the scope. In fact, it is the object clause which defines the entire contractual capacity of a company. A company is having a free will to select any objects they want to select, but those objects should always and always be lawful in nature. Don't select an object which is illegal in nature or unlawful in nature. The object clause is divided into two parts: main object, other objects. The main reason for which the company came into existence is nothing but the main object. Something which is other than main thing is considered to be other objects of the company. So object clause is one of the lengthiest clause inside the MOA of a company. In fact, it is the third clause inside the MOA. The first clause being the name clause, the second clause being the registered office clause, the third clause is the object clause, which defines nothing but various objects of the company. In short, what a company can do. The fourth clause inside the MOA of a company talks about the liability clause. Inside the liability clause, the provision can either be towards section number 2, clause 21, or it can be a provision towards section number 2, clause 22, or it can be a provision towards section number 2, clause 92. If the company is limited by guarantee, then inside the memorandum, the company will write down an amount. This is the maximum amount the company will call up from its members at the time of liquidation when the company is not in a position to pay off its liabilities. However, if the company is limited by shares, then section number 2, clause 22, wherein the liability of every member is limited, that is only and only up to the unpaid value of shares. If the shares are fully paid up, then in that case, there is no liability of a member. However, if your company is having an unlimited liability, then section number 2, clause 92, which talks about the members having an unlimited liability, wherein even the personal assets of the members will be held responsible to pay off the liabilities of the company. The fifth clause inside the MOA is a capital clause. This clause, that is capital clause, is there only and only in case of a company having a share capital. If your company does not have a share capital, If your company does not have a share capital, then you don't need to have a capital clause. Sir, what is written inside this capital clause? Inside this capital clause, an amount has been written which is acting as an authorized share capital of a company. Which is acting as an authorized share capital of a company. In your accounts, you have come across, in your accounts subject, you have come across many a times that a company can issue maximum shares which is there as per their authorized share capital. The issued share capital cannot be more than the authorized share capital. For example, in my company, it has been mentioned that our company is authorized to issue maximum 1 lakh shares of rupees 10 each. Hence, the authorized share capital is 10 lakh rupees. So can my company issue more than 1 lakh shares? No, I cannot issue more than 1 lakh shares. If I go for issuing more than 1 lakh shares, I'm going against my MOA, which is ultra vires, that is void ab initio, beyond the powers. So capital clause is a clause which is there only and only in case of a company having a share capital, wherein this clause explains us nothing but the authorized share capital of a company. The next clause is the subscription clause or the association clause. What is a subscription clause? Inside this clause, we have to write down the details of subscribers. The persons who had subscribed the MOA of our company. We have to write down their details. We have to write down their details over here. Over here. We have to write down the details of the subscribers. However, if the company is having a share capital, then every subscriber should at least subscribe for 1 share. And whatever are the number of shares they are subscribing, it will be written against their names, and all those shares should be fully paid up. Because with that money only, the company is going to commence the business. Are you getting me or not? So subscription clause or association clause deals with the details of subscribers. If the company is having a share capital, then every subscriber should at least subscribe for 1 share. However, they can also subscribe for more number of shares. Whatever are the number of shares they are subscribing for, all those shares should be fully paid up, because with that money only, the company is going to commence the business. Over here, in case of a private company, minimum 2 subscribers, and in case of a public company, there has to be minimum 7 subscribers. Last clause, that is a succession clause. However, this clause is there only and only in case of a 1-person company. Which means if there is a company other than 1-person company, then they don't need to have a succession clause. Succession clause is there only and only inside the memorandum of a company called as 1-person company. Because inside this clause, we have to write down the details of nominee. Yes, once the original member dies, then the nominee will start acting as the member of that company. So succession clause is there only and only inside the memorandum of a 1-person company, which talks about the details of the nominee of that 1-person company. So friends, with this, we have completed our topic towards memorandum of association. Let us move on ahead towards a topic called as Articles of Association, that is AOA. Yes, friends, even Articles of Association are considered as a fundamental document for a company. Because if you have a look under section number 7, which talked about the procedure for incorporation of a company, wherein under step number 4, we had to prepare MOA and AOA. Then under step number 5, we had to submit both the documents. Then only under step number 6, the company was getting incorporated. So whether you talk about memorandum of association or whether you talk about articles of association, both the documents, yes, both the documents are fundamental documents without which a company cannot get incorporated. Memorandum of association is considered as charter of the company, whereas articles of a company are prescribing nothing but the bylaws for the company, that is rules and regulations which are required for conducting the business of the company. It talks about the internal affairs of the company. If MOA talks about what a company can do, then articles will speak about how the things will be done. If you compare articles and memorandum, both are fundamental, but memorandum is a primary document and articles are nothing but subordinate one. MOA defines the objects of the company, whereas articles defines the rules to achieve those objects. Over here. Law says articles of a company can never ever go against the memorandum of the company. Articles can never go against the memorandum. So memorandum is more powerful as compared to articles. So memorandum is a primary one, articles is a subordinate one. So articles will never ever go against its own charter, against its own memorandum. Articles will never go against Companies Act, and articles will never permit something which is illegal in nature, because articles is nothing but set of rules and regulations required for conducting the business of the company, that is nothing but the internal affairs of the company. So memorandum defines the objects of the company, that is what the company can do, whereas articles will define the rules to achieve those objects, that is how the objects are to be carried out. Over here, the word articles of association is actually defined under section number 2, clause 5. So friends, henceforth, whenever I'm going to talk about articles of association, the very first thing which is going to run in your mind is section 2, clause 5. Section 2, clause 5. Law says articles means articles of association. That's so funny again. Articles means articles of association of a company as originally framed or altered from time to time as per the provisions of previous law or as per this act. So the definition of memorandum and articles are trying to say one and the same thing. Even articles are allowed to be altered. How to alter is a concept which is we are going to cover in our inter-CA level. Memorandum, yes, you can alter them. Articles, yes, you can alter them. If this is the articles of my company, they are originally framed. It is still considered as articles of association. But in future, if I alter them, then even after alteration, they will be considered as articles of association. So articles of association can either be in an original form or it can also be altered from time to time. And such things are being done as per the provisions of Companies Act 2013, or they were being done as per any other previous law related towards companies. Reliance Industries Limited got their articles of association as per Companies Act 1956. Till date, it is considered as articles of association. However, if today Reliance Industries Limited wants to alter their articles, they will alter it as per the provisions of Companies Act 2013. And after alteration also, it will still be considered as articles of association. Sir, how to form an articles of association? Articles of association will be formed as per schedule number 1. Whether you want to form memorandum or whether you want to form articles, both the documents are being formed as per schedule number 1. Schedule number 1 comprises of 10 tables, wherein the first 5 tables are utilized for the preparation of MOA and last 5 tables are utilized for the preparation of AOA. That is table number F, G, H, I and J are the tables which are required for preparation of articles. Sir, we can select any table as per our own choice? No. You have to select the table depending upon the type of company it is. Table number F is for the company limited by shares. Table G is for company limited by guarantee having a share capital. Table number H is for a company limited by guarantee having no share capital. Table I is for a company having unlimited liability having share capital. And table J is for a company having unlimited liability having no share capital. So depending upon the type of a company, you have to select the respective tables. Yes, law says that even articles of association should be in a printed form, wherein everything should be in a paragraph manner. Every paragraph should be numbered, article should be subscribed, and yes, there has to be a witness for the same. So whether you talk about memorandum of association or whether you talk about articles of association, both the documents shall be in a printed form, paragraph, numbered, subscribed, and witnessed. Are you sure? Yes. Yes, friends. Inside articles of association, you can have a provision which talks about entrenchment provision. This is something new which has been introduced under Companies Act 2013. Such provision of entrenchment was not there under Companies Act 1956. What does entrenchment provisions try to say? Generally, can you alter your articles? Yes, it is allowed. We have to follow a procedure given under section number 14, which we are going to understand at our inter CA level. Now, if your articles is having a provision of entrenchment, then in that case, you can alter your articles. You can alter your articles only if you are going to follow more restrictive conditions or procedure as compared to those applicable in case of special resolution. Generally, a company can alter their articles, but if your articles is having an entrenchment provision, then you can alter your articles only when you are going to follow something which is more restrictive in nature as compared to special resolution. What is a special resolution? It requires a special majority, wherein 75% or more of the votes shall be in the favor of the resolution. In your inter CA, friends, you will come across ordinary resolution and special resolution. I will minimum take 45 minutes to explain you what is ordinary resolution, what is special resolution. But it is not there at your foundation level. I just said in my yesterday's lecture that at foundation level, you just to have a glimpse of Companies Act. We'll be discussing all these things again in detail at our inter CA level with something additional points, additional provisions, additional chapters. Final CA, Companies Act is going to come to an end. So my journey with you all is right from foundation. It gets continued at your inter CA, and yes, it will be also there at your final CA level. So if the articles is having an entrenchment provision, then in that case, you can alter your articles only when you are going to follow something which is more restrictive towards special resolutions. Sir, if my articles don't have an entrenchment provision, but now we want to have an entrenchment provision, okay, then you can amend your articles. Then in that case, a private company can amend it by getting the consent of all the members, whereas a public company can amend it by passing a special resolution, and you can introduce the provision of entrenchment inside your articles. Yes, friends, last point under Companies Act 2013, last point, that is various doctrines. We have got three doctrines over here. That is doctrine of ultra vires, doctrine of constructive notice, and doctrine of indoor management. Let us first begin our concept towards doctrine of ultra vires. Ultra vires stands for beyond the powers. Beyond the powers. Whenever I say ultra vires, means the company has done something beyond the powers. In that case, it is void ab initio. Whenever a company wants to enter into a contract, a company can enter into those contracts which are allowed by its memorandum and articles. To be more precise, allowed by memorandum. Whenever a company does something which is beyond memorandum, then that activity is considered as ultra vires, that is beyond the powers. See, in your family, you are a child, you got a father, you got a mother. You are a child means you are a company. Your father is nothing but memorandum and your mother is nothing but articles of association. Being a child, if you go against your father, means you have done something which was beyond your powers. Void ab initio. So whenever a company does something which is beyond the memorandum of association, the company was not authorized to do it, but then also the company did it, then it is considered as void ab initio. It is absolutely void from the beginning. However, a company if goes against articles, then that things can be ratified with the consent of the shareholders. That things can be ratified with the consent of the shareholders. So over here, if you are going against the articles, wait, it can be ratified. It can be ratified, then it is okay. But if you are going against the memorandum, sorry, an act which is ultra vires the company being void cannot be ratified by the shareholders of the company. So you are allowed to go against your articles if later on it is going to get ratified by the shareholders. But you can never ever go against your memorandum. So memorandum is the charter and articles is nothing but the set of rules and regulations, that is bylaws for the company. For this, we have done a case study called as Ashbury Railway Carriage and Iron Company Limited versus Rish. In this case study, we had understood that the company had acted beyond the powers. The company entered into a contract which was not allowed by its memorandum of association, and the contract was something called as void ab initio. Let us go on to the next doctrine, which talks about doctrine of constructive notice. Friends, this word notice is actually derived from a Latin word notitia. The word notice is actually derived from a Latin word notitia, wherein notitia stands for to give knowledge. Notitia stands for to give knowledge. Over here, friends, when I talk about constructive notice, what is a constructive notice? First of all, let me give you an example. I wanted to make an announcement in the classroom. So I came inside the classroom and I gave you all notice. I gave you all some kind of a knowledge that from day after tomorrow, you will be having a Diwali vacation. So this is the notice. This is the knowledge which I actually gave you in the classroom. It's an actual notice. But if at all I feel not to approach to your classrooms, I just thought I don't want to give an announcement in the classroom. I just put down a notice upon a notice board. The moment I put a notice upon a notice board, I've done my obligations, I've done my duties. I can start presuming that the students will have a look upon the notice board and they will get the knowledge about the notice. Acha, when I'm putting a notice upon the notice board, will I come to a classroom and say, please have a look upon the notice board? No. If I wanted to do that thing, then I would have easily given you the notice for the same. So once a professor has put down a notice upon a notice board, he can start presuming that the notice will reach to the knowledge of every student, irrespective whether the student has read the notice or not read the notice. Now it is the duty of the student to have a look upon the notice board. If the student has read the notice, it's best for him. If the student did not read the notice, it's all the best for him. Similarly, it happens in case of a company. Every company has got two documents. One is memorandum of association, another is articles of association. The company files both these documents to the office of registrar, that is ROC. The office of registrar is nothing but a public office. Once the documents are being filed at a public office, they are deemed to be a public documents. Now the company will start assuming that any outsider who is going to enter a contract with our company will be having the knowledge towards the MOA and AOA of our company. Friends, this doctrine of constructive notice is acting as a very good friend of a company and it is going against the outsider. Yes, this doctrine is operating as a dark cloud upon the outsiders. It is always and always going to support the company. As per the provisions of doctrine of constructive notice, any outsider entering a contract with the company shall be having the knowledge about the MOA and AOA. If the outsider does not have the knowledge of MOA and AOA, then it is the fault of the outsider, not the company, because the company has already filed these documents to the office of ROC. And the office of ROC is nothing but a public office, hence these documents are public in nature. If a professor has put down a notice upon a notice board, the professor can start assuming that the students have read the notices. In a similar way, when a company has filed the documents to the office of ROC, the company will start assuming that any outsider who has entered a contract with our company will have got the knowledge about the contents of the MOA and DOA. If the outsider has not got the knowledge, it is the fault of the outsider, not the company. So this doctrine of constructive notice is supporting nothing but the company, and it is acting as a dark cloud upon the outsider. But on the other hand, exactly opposite is doctrine of indoor management. Yes, friends, doctrine of indoor management is going to support the outsider and it is going against the company. Yes, it is acting as a silver lining to the doctrine of constructive notice. Doctrine of indoor management says that, okay, it is the duty of the outsider to have the knowledge of MOA and AOA. But if the outsider has got the knowledge of MOA and AOA, but the company itself is not fulfilling the provisions of MOA and AOA, then it is the fault of the company and not the outsiders. So doctrine of indoor management says what? That yes, the outsider will have a knowledge of MOA and AOA. But if the company itself does not functions as per the provisions of MOA and AOA, then it is the fault of the company and not the outsiders. So doctrine of indoor management is supporting the outsiders and it is acting against the company. However, this doctrine of indoor management has got three exceptional cases. In these three exceptional cases, the doctrine is supporting a company and it is going against the outsiders. Generally, indoor management supports outsider, goes against the company. But in these three exceptional cases, doctrine of indoor management is supporting a company and it is going against the outsider. Whenever the outsider is having a knowledge of irregularity, then it is the fault of the outsider and not the company. The second exceptional case, whenever the outsider is having some kind of the outsider has been suspicious, then also the outsider is working negligently, then it is the fault of the outsider and not the company. As it was held in case of Anand Bihari Lal versus Dinshu and Company. In that case, the accountant of the company was selling the property of the company. Outsider Mr. Anand Bihari Lal was suspicious that how can an accountant sell the property of the company? Then also that outsider was working negligently and he paid the entire amount of funds to the accountant, assuming that yes, he will have got the power to sell the property of the company. He outsider, you are so much negligent. How can an accountant of a company sell the property of the company? No, not allowed. It is a fault of the outsider because the outsider has worked negligently. It is a case of negligence, then sorry, we are not going to support you. We are going to support the company and not the outsiders. Last exceptional case, that is forgery. Forgery stands for fraud. Outsider has done a fraud. If the outsider of the company has done a fraud, then sorry to say, the doctrine is going to support the company and not the outsider. Generally, doctrine of indoor management supports the outsider and it is going against the company. But in the following three exceptional cases, the doctrine is going to support the company and it is going against the outsiders. That is in case of knowledge of irregularity, in case of negligence shown by the outsider, or whenever an outsider is trying to do a forgery, that is the outsider is trying to do a fraud. So friends, with this, we have successfully completed our Companies Act 2013. We will be moving towards the second last chapter of our CA Foundation Business Law, that is Sale of Goods Act 1930. But before starting with this topic, we'll go for a break for 5 minutes. Thank you, friends. Yes, friends, a very good afternoon to you all once again. Over here, friends, before the break, we had completed a topic called as Companies Act 2013. Now, we are upon the second last chapter, that is Sale of Goods Act 1930. Yes, friends, the weightage of this chapter will be there somewhere around for 12 to 14 marks in your November 2020, which is now scheduled for December 2020 exams. Over here, over here, friends, when I say a topic called as the Sale of Goods Act 1930, then first of all, the words 1930 clearly represents the year of applicability of this act. Over here, the rules and regulations for selling of goods. The rules and regulations for selling of goods was made applicable from a year called as 1930. Over here, friends, the word act, the word act stands for specific rules and regulations. So when I say act, we are talking about specific rules and regulations, that is rules and regulations only and only towards selling of goods. Rules and regulations only and only towards selling of goods. And all these rules and regulations towards selling of goods was made applicable from a year called as 1930. To be more precise, it was from 1st July 1930. It was from 1st July 1930. Yes, friends. So this act came into force on 1st July 1930, wherein this entire act is applicable to whole of India. This entire act is applicable to whole of India. Over years, friends, the provisions of this act was previously given under chapter number 7 of Indian Contract Act 1872. Yes, prior to the years of 1930s, the rules and regulations towards selling of goods was given under Indian Contract Act 1872. So just imagine the size of Indian Contract Act prior to the years of 1930. Because prior to the years of 1930, Indian Contract Act was dealing towards the rules and regulations of contract. It was also dealing towards rules and regulations towards selling of goods, and it was also dealing towards rules and regulations of partnerships. However, in the years of 1930, we separated the rules towards selling of goods and we formed a new act called as Sale of Goods Act. Similarly, in the year of 1932, we just separated the rules of partnership from Indian Contract Act and we got a new act called as Partnership Act 1932. So whatever are the rules and regulations, which you are going to study under this chapter, that is Sale of Goods Act 1930, all those rules and regulations were previously given under chapter number 7 of Indian Contract Act 1872. Over here, whenever the provisions towards Sale of Goods Act are silent, then yes, the general principles of the law of contract shall be made applicable. So whatever are the general principles of contract, that is whatever the provisions towards Indian Contract Act, all those rules and regulations are also applicable at the time of selling of goods, provided the Sale of Goods Act is silent for those rules. So when the Sale of Goods Act is silent, the general principles of Indian Contract Act shall be made applicable. Which means, if I am a seller and you are a buyer, you cannot take my consent of selling the goods through coercion. If you have done it, it's a voidable contract. Sorry, Sale of Goods Act is silent for the same, but yes, the general principles of law of contract shall be made applicable. Over here, friends, I have made two golden rules for this entire chapter. I have made two golden rules for this entire chapter. Over here, when I say golden rules, so can I say all such golden rules has to be bound to be followed? You studied accounts. Then yes, in accounts there were three golden rules. So over here, under Sale of Goods Act 1930, I have drafted two golden rules. Golden rule number one: Whenever you talk about goods, so can I say goods are of two types? That is movable goods and immovable goods. Goods which can be moved from one place to another place are called as movable goods. Whereas the goods which are not movable from one place to another place are called as immovable goods. In this entire chapter, whenever I am going to discuss about goods, I am going to discuss only and only towards movable goods, which means we are going to ignore immovable goods. We are going to discuss the rules and regulations for buying and selling of movable goods, because we are over here to discuss a chapter called as Sale of Goods Act. However, the rules and regulations towards immovable goods are given under Transfer of Property Act. We are not over here to discuss Transfer of Property Act. We are over here to discuss Sale of Goods Act. Hence, for us, goods means movable goods. Golden rule number 2. Goods are transferable. And when there is a transfer only of possession, it is called as bailment of goods. We are not over here to discuss a transfer of only possession. Along with the possession, there has to be a transfer of ownership. Then only we can say that the goods are being sold. So along with the transfer of possession, there has to be a transfer of ownership of the goods, which means there is selling of goods. We are not over here to discuss bailment of goods. We will discuss bailment in our inter-CA level called as contract of bailment, wherein there are two parties. One is a bailer, another is a bailee. The person who transfers the possession is the bailer, and the person to whom the possession has been transferred is the bailee. I wanted to go to a place called as place B. Place B. So I wanted to travel from place A to place B. I did not have a bike. So I went to my friend. I just told him that, can I get the keys for your bike? I want to travel from place A to place B. My friend handed over the keys to me, which means he has just given me the possession of the bike. I am not becoming the owner of the bike. There was no process of selling over here. It was a process of bailment, for which Sale of Goods Act is silent. Sale of Goods Act talks about transfer of possession along with transfer of ownership, which means there has to be selling of goods. And whenever you talk about selling of goods, there are two parties. One is the buyer, another is the seller. So we are not over here to discuss number 1, something towards immovable goods, and we are not over here to discuss something about the transfer of possession only, that is in case of bailment of goods. These two things we have to eradicate. Goods means movable goods, and transfer means there has to be a transfer of possession along with the ownership of the goods. Over here, friends, whenever I am talking about selling of goods, whenever I'm talking about selling of goods, so can I say selling of goods is actually nothing but a kind of a transaction? Selling of goods is nothing but actually a kind of a transaction. When I am going to a market to buy some goods, the seller sells me the goods, I am buying those goods, which means there is a process of transaction between me and the seller. So whenever you talk about selling of goods, it is nothing but a transaction. And in law, we have understood in the very first lecture that whenever you are entering into a transaction, in the eyes of law, you are actually entering into a contract. The selling of goods is a transaction, which means you are entering into a contract. Generally, in a contract, there are two parties. One is a promisor, another is a promisee. Generally, in a contract, there are two parties. One is a promisor, another is a promisee. But we are not talking about contract. We are talking about contract towards selling of goods, which is called as contract of sale. So selling of goods is a transaction. If it is a transaction, it is a contract, and that contract is called as contract of sale. So if at all I ask you what is a contract of sale, then for a layman, contract of sale is nothing but a contract. Contract of sale is nothing but a contract towards selling of goods. So whenever you are selling goods, you are entering into a contract, and that contract is called as contract of sale. A general contract is between buyer and seller. Sorry, a general contract is between promisor and promisee. But when I talk about contract of sale, it is a contract between a buyer and a seller. Who is a buyer? Buyer means any person. Buyer means any person who buys the goods or agrees to buy the goods. Either you buy it or you agree to buy it, then yes, you are considered as something called as the buyer. Who is a seller? Seller means any person. Seller means any person. Seller means any person who either sells the goods or agrees to sell the goods. Either you sell it or you agree to sell it. In the eyes of law, you are a seller. So yeah, once again, friends, contract of sale. It is a contract between a buyer and a seller, wherein the buyer will either buy the goods or he will agree to buy the goods. The seller will either sell the goods or he agrees to sell the goods. Which means under contract of sale, there can either be a sale or there can either be an agreement to sell. If it is a sale, then the ownership has been transferred immediately. The ownership has been transferred immediately. In fact, it is nothing but an executed contract. But when I say agreement to sell, the ownership is going to get transferred at a future date, which means the contract is executory in nature. So whether you go for a sale or whether you go for agreement to sell, whether you go for a sale or whether you go for agreement to sell, in the eyes of law, the contract gets formed, and that contract is nothing but contract of sale. Once upon a time, I wanted to buy a mobile phone. To be more precise, I wanted to buy iPhone 11 Pro Max. So I went to a store called as Chroma and I bought the phone iPhone 11 Pro Max, which means it is a contract of sale wherein there was a sale. The ownership of the mobile phone was been immediately transferred to me. However, if I give a second example over here, I wanted to buy iPhone 11 Pro Max gold plated. The seller said he does not have a gold plated iPhone 11 Pro Max. I was very much sad by listening to the words, the product is not available. But the seller made a point. The seller said, okay, right now I don't have this product, but give me 10 days. I will arrange the product for you. And after 10 days, I will sell it to you. I said, okay, after 10 days, I will buy it from you. So it was an agreement to sell, wherein the ownership of the goods is going to get transferred at a future date. In that case, also I was a buyer and that person was also a seller. So either you buy the goods or you agree to buy. In the eyes of law, you are a buyer. Either you sell it or you agree to sell it. In the eyes of law, you are a seller. So whether you go for a sale or whether you go for an agreement to sell, in the eyes of law, a contract is getting formed, and that contract is nothing but contract of sale. Over here, friends, let us discuss the entire definition towards contract of sale. Yes, friends, the entire definition towards contract of sale is given under section number 4 of Sale of Goods Act 1930. Yes, it is section number 4 of Sale of Goods Act 1930, which deals with the definition towards contract of sale. So henceforth, friends, whenever I'm going to discuss something towards contract of sale, the very first thing which is going to pop in your mind is nothing but section number 4. The very first thing which is going to pop in your mind is nothing but section number 4. Let us have a look towards the entire definition of contract of sale. The definition is read as follows. The definition says contract of sale is a contract whereby a seller either transfers or agrees to transfer the property in the goods to a buyer for a price. Let us discuss each and every point in detail. The very first point, contract of sale. What is it? The law says it is a contract. Wow. Contract of sale is a contract. If it is a contract, which means the provision of section number 2b plus section number 2e plus section number 2h is going to get followed. That is nothing but what is contract under Indian Contract Act 1872. So contract of sale is nothing but a contract. It is a contract between a seller and a buyer. It is a contract between a seller and a buyer. You know now who is a seller? Seller means any person. Seller means any person who either sells the goods or agrees to sell the goods. In a similar way, buyer means any person who either buys the goods or agrees to buy the goods. So contract of sale is a contract whereby a seller does what? The seller will transfer. The seller will transfer. What will he transfer? The property in the goods. What will he transfer is the property in the goods. One thing is for sure. Seller never sells the goods. No, no. Buyer never buys the goods. I know you will be abusing me now. That this fat man has gone mad. When we say seller, it's pretty obvious the seller sells the goods, buyer buys the goods. No, no. Seller never sells the goods. Seller actually sells the property in goods. When I say property in goods, which means seller sells the general property. The seller sells the general property in goods, which is nothing but ownership in goods. So seller is selling the ownership in the goods. Buyer does not buy his goods. The buyer over here is buying the general property of the goods. That is, the buyer is buying the ownership of the goods. So contract of sale is a contract whereby a seller transfers. If it is transferring it, then it is something called as a sale. He's selling the ownership in goods to a buyer, or else he's agreeing to transfer, which means he has not transferred, but he has agreed that he will transfer the ownership in a future date, which means it is nothing but agreement to sell. It is nothing but agreement to sell. So either the seller will sell or he will agree to sell. Either the seller will sell or he will agree to sell. What? Property in the goods. That is the general property in goods. That is the ownership in goods. To whom he will do it? He will do it to a buyer. All these things will the seller do for free? No, he will do it for a price. Price over here is nothing but consideration for the seller. Price over here is nothing but the consideration for the seller to transfer or agree to transfer the property in goods to the buyer. This price is nothing but a money consideration. The price over here is nothing but a money consideration, but not in case of money's worth. It has to be money and not money's worth. If the seller says, I will sell you an air condition and in return you give me a laptop. This is a barter exchange. So whenever you talk about a price involves money and not money's worth. Okay. If it is in partly money and partly money's worth, law says it is allowed. Partly money is worth, allowed. Completely money is worth, not allowed. Completely in case of money, 100% allowed. Once upon a time, I wanted to buy a Mercedes car. So I went to the showroom called as Mercedes showroom. The car dealer over there showed me a few cars and I booked one of the car. But then I raised a suggestion to the car dealer that I already got an old car. What should I do of that old car when I'm buying a new car? The car dealer said, okay, so you give us the old car, whatever is the balance money left out, you pay us in case of cash or check. So over here, when I'm buying a new car, then in return, the price which I paid was partly in money and partly in money's worth, which is 100% acceptable. So price generally has to be in a form of money's consideration. Money should be the consideration and not money's worth. However, at times, if it is partly money and partly money's worth, then yes, it is still allowed. So friends, if you have a look upon the entire definition of the contract of sale, then we have discussed each and every provision towards contract of sale. The only point of discussion left out The only point of discussion left out is nothing but the word called as goods. So, friends, let us understand the definition of the word called as goods. The word goods is actually been defined under section number 2, subsection 7 of Sale of Goods Act 1930. So henceforth, whenever I'm going to shout out the words called as goods, the very first thing which is going to flow in your mind is nothing but section number 2, subsection 7. Let us have a reading towards the definition of the goods, and then I will give you the explanation towards the meaning of the word goods. Law says goods means every kind of movable property other than actionable claims and money. So goods does not include two things. It does not include money. It does not include actionable claims. However, it includes stock, shares, growing crops, growing grass, and things attached to or forming part of the land which are agreed to be severed before the sale or under the contract of sale. This is the entire definition of the words called as goods. However, let us have an easy manner of understanding the definition of the word called as goods. The entire definition over here I have divided into a chart form, wherein I have divided the goods into two parts. Goods includes what all things and goods excludes what all things. Number one, goods over here will exclude immovable property. It will exclude, number one is nothing but the immovable property. So anything which is not movable in nature is not considered to be goods under Sale of Goods Act 1930. Immovable goods will be considered as goods. Immovable property would be considered as goods under Transfer of Property Act, but not under Sale of Goods Act. So goods excludes immovable goods. It excludes money. Yes, money is not goods. Can you buy money? No. Can you sell money? No. Can I shout in the market saying that 2000 rupees ka note at 5000 rupees? No. The people will start hitting me. You cannot buy money, you cannot sell money, hence money is not considered as goods. But sir, one day my father had bought some dollars. Your father never bought dollars. Your father got the Indian currency exchanged with a foreign currency. It was not a buying and selling of money. It was exchange of money. So money is not considered as goods. Money is something which we pay for to get the ownership of the goods. But money is not considered as goods. In a similar way, actionable claims are not considered as goods. We already discussed what are actionable claims in our video lectures. So, money, actionable claims, immovable goods, and yes, services. These four things are being excluded from the definition of goods. See, JK Shah classes over here is providing services to the students. So in that case, we have not entered into Sale of Goods Act. We are not entered into a contract of sale. It is just a mere contract under Indian Contract Act, but not a contract under Sale of Goods Act. So goods does not include immovable goods. It does not include money. It does not include actionable claims, and it also does not include services. However, goods includes something which are movable in nature, that is movable property. It includes stocks, shares. But wait, goods also include something called as growing grass, growing crops, things attached to land, things forming part of land. These three things which I have circled, if you practically see, they are immovable in nature. But then also they are included over here, provided it is severed, which means it has been cut, or it is agreed to be severed. Either you cut it or you agree to cut it, either before the sale or under the contract of sale. Then all those things are not considered as immovable, they will be considered as movable. So growing grass, growing crops, things attached to land, things forming part of land, all of them are actually immovable. But if they are severed, they are being cut, or they are agreed to be severed, then they are considered to be movable in nature. Yes, goods includes patents, copyrights, goodwill, trademarks. It also includes something called as ship, water, electricity, gas, fixed deposits, etc. So this is nothing but the list of the things which are included inside the definition of goods. Is money considered as goods? Law says no. Money is not considered as goods. But when it comes to antique money, old currency notes, old currency coins, then yes, they are considered as goods. Money is excluded, but antique money, antique coins, old currency notes, they are considered as goods because we can easily buy them and we can easily sell them in an open market. Over here, friends, this was the discussion towards definition of goods. Let us move on ahead towards the next part, which talks about classification of goods. Yes, friends. The word good, the word goods can be classified under three headings. That is, goods can be classified as existing goods. It can be classified as future goods. It can also be classified as something called as contingent goods. Let us first discuss what do you mean by existing goods. Yes, friends, existing goods are those goods which are in existence when the contract of sale was formed. So when the contract of sale was entered, at that time, the goods were in existence. One fine day, I went to a grocery shop and I said to the uncle over there, "Hey uncle, do you have a Parle-G biscuit ka packet? Do you have a packet of Parle-G biscuit?" The uncle said, "Yes, we do have." The goods are existing in nature. So when the contract of sale was getting entered between me and that grocery shop owner, at that time, the goods were in existence. The second basis is nothing but future goods. Future goods are those goods which are not in existence. In fact, they are yet to be manufactured, yet to be produced. They are the goods which are going to come into existence, but in future, not right now. Then such goods are called as future goods. Such goods are called as future goods. The future goods are those goods which are actually not in existence. They are yet to be manufactured, yet to be produced. They will come into existence in future. So whenever you talk about future goods, then always and always remember, in future goods, there is no sale, but there is agreement to sell. There is no sale, but there is agreement to sell. One fine day, I wanted to purchase 10,000 kgs of rice. So I went to a farmer and I said to the farmer, "Hey farmer, do you have 10,000 kgs of rice?" Farmer said, "No, he does not have 10,000 kgs of rice," which means the goods are not in existence. I was very, very sad by listening to the words of the farmer that he does not have 10,000 kgs of rice. But farmer later on said to me that he will cultivate the rice and later on he will sell me the rice. I said, "Okay, whenever you cultivate, do sell it to me," which means there is an agreement to sell between me and the farmer. The ownership of the goods is going to get transferred at a future date. When iron farmer entered into a contract, at that time, rice was not in existence. The rice was yet to be manufactured, yet to be produced. It was going to arrive in future. Then yes, these goods are called as future goods. Last, contingent goods. What do you mean by contingent goods? Contingent goods are those goods which are dependent upon happening or non-happening of certain contingencies. Any such goods which are dependent upon happening or non-happening of certain contingencies, then those goods are called as contingent goods. For example, one fine day, I went to the farmer and I said to the farmer that, "Hey farmer, do you have 5,000 kgs of rice? Would you like to sell it to me?" The farmer said, "I can sell it to you only when one of my friend Ramu sells to me. If Ramu sells to me, I will sell it to you." Which means The contract between me and farmer is dependent upon the behavior of Ramu. If Ramu does not sell it to the farmer, farmer won't sell it to me. This is an example towards contingent goods. Or else the farmer says, okay, I will sell it to you if it rains tomorrow. So tomorrow there might be a rain, there might not be a rain. If it rains, then the farmer will sell it to me. If there is no rain, the farmer won't sell it to me. This is again an example of contingent goods. The goods can be classified under three headings: existing goods, future goods, contingent goods. If the goods are in existence when the contract of sale was made, they are called as existing goods. However, if the goods are not in existence, they are yet to be manufactured, yet to be produced, then such goods are called as future goods. Whereas goods which are dependent upon happening or non-happening of certain contingencies, then those goods are called as contingent goods. Now, friends, existing goods can be further classified as specific ascertained goods, or it can be classified as unascertained goods. Let us first understand what do you mean by specific ascertained goods. Specific ascertained goods are goods which are in existence and they are identified at the time of sale. The identification is done that yes, this is the product which the seller is going to sell to the buyer. The identification has been done. Then those goods are called as specific ascertained goods. I went to the seller and I said to him, Ye wala, I want this biscuit. I want this packet of biscuit. The seller said, this packet? I said, yes, this packet only. The seller said, okay, I'm selling you this packet only. So the identification was done at the time of sale. It is specific ascertained goods. The seller knows that this is the packet which he is going to sell it to the buyer. That is, identification has been done. Then what do you mean by unascertain goods? Unascertain goods are those goods which have been indicated but not yet identified. The seller knows what buyer wants, but seller does not know which packet he wants. For example, I said, hey seller, do you have a packet of Parle G? The seller said, yes, we do have packet of Parle G, which means the goods are in existence. I said, okay, sell it to me. Seller said, okay, I will sell it to you, which means there is a contract of sale. The goods are been identified. Sorry, the goods are been indicated that the buyer wants Parle G biscuit. The seller is going to sell Parle G biscuit. Now the seller has got 1,000 packets of Parle G biscuits. Out of this 1,000 packets, which packet is going to sell to the buyer? That is not been indicated. So that is not yet been identified. Sorry, not yet been identified. So goods which are indicated but not yet identified are unascertained. The moment they are identified, it becomes ascertained. At the time when the contract was entered, at that time it was just indicated, not identified, unascertained. Afterwards, it has been identified. The seller said, okay, out of this 1,000 packet, I'm going to sell this packet to the buyer. Then this packet is nothing but now ascertained goods because the identification has been done. So goods which are been identified at the time of sale, specific goods. Not at all identified, but just indicated, then they are uncertain goods. Are you all sure? Okay. Let us understand the next concept, which talks about delivery. What is delivery of goods? See, whenever you talk about contract of sale, contract of sale is a contract between a buyer and a seller. They are the two parties, wherein the buyer's performance is to make the payment of the goods and seller's performance is to deliver the goods. So when I say contract of sale, what is the duty of a buyer? The duty of buyer is to make the payment of the goods. What is the duty of the seller? The duty of the seller is to deliver the goods. So who delivers the goods? It is the seller who delivers the goods to the buyer. So what do you mean by delivery? Delivery means voluntary transfer of possession of goods from one person to another person. The main word over here is voluntary. Don't just write down a word called as transfer of possession. No. One fine day I come to your house and I just take away your mobile phone at the pinpoint of a gun. Then in that case also, there is a transfer of possession. But that does not mean that you have delivered the goods to me. You have delivered the mobile phone to me. In fact, I've done something called as an unlawful activity. So whenever I talk about delivery of goods, it is voluntary transfer of possession of goods from one person to another person. So there has to be a voluntary transfer of possession of goods from seller to the buyer. Then it is called as delivery of goods. The grocery shop owner is voluntarily transferring me the possession of one packet of Parle-G biscuit, which means he has delivered me one packet of Parle-G biscuit. So whenever you talk about delivery of goods, delivery means it has to be something called as a voluntary transfer of possession of goods from one person to another person. Yes, friends, delivery are of various types. You have already come across a delivery called as an actual delivery of goods, symbolic delivery of goods, constructive delivery of goods. What do you mean by actual delivery of goods? The goods are actually delivered. The contract was entered for a biscuit of Parle-G, a packet of Parle-G biscuit. The seller is delivering the packet of Parle-G biscuit to the buyer. So the goods is nothing but actually delivered. The product for which the contract was entered, that product itself has been delivered. It is called as an actual delivery. What do you mean by symbolic delivery? In that case, some symbols are being delivered. Some symbols are being delivered, which symbolizes that the goods are being delivered. One fine day, I wanted to buy a car. I made the entire payment to the car dealer. Now it is the car dealer who has to deliver me the car. Then pretty obvious, the car dealer won't lift the car and he will give it on my hands. The car dealer gave me the keys of the car. The keys of the car is symbolizing that the car has been delivered to me. That's a symbolic delivery, that is giving a key for a car. Last one, constructive delivery. In case of constructive delivery, there is no actual change in the possession of the goods. The person who was holding the goods for Mr. A, now that same person is holding the goods for Mr. B on A's request. Means what? I am a farmer. Whatever are the goods which I have cultivated, I have stored those goods with a warehouse keeper. Which means I am the owner of the goods, but the warehouse keeper has got the possession of the goods. One fine day, a businessman is coming to me and he wants to purchase 10,000 kgs of rice. I said, okay, I'm ready to sell you 10,000 kgs of rice. I already have it at the warehouse keeper. I already have it with the warehouse keeper. The businessmen have made me the payment of entire kgs. Now, businessman said to me, where is the rice? I said, it is with the warehouse keeper. You can take this receipt and you can collect your delivery from the warehouse keeper. The businessman said to me, sir, one small request. The goods which I'm going to buy from you, that is 10,000 kgs. I myself is going to keep that goods at the warehouse. Sir, it's better you just make a request to your warehouse keeper that the goods which he was holding right now for the farmer, he should now start holding that goods for the businessman. I said, okay, I will tell to the warehouse keeper that whatever are the goods you were holding on my behalf, please now onwards hold that 10,000 kgs of rice on behalf of the businessman. It is nothing but a constructive delivery wherein the actual possession of the goods has not got changed. The person holding the goods on behalf of Mr. A is now holding the goods on behalf of Mr. B on A's request. That is called as a constructive delivery of goods. What is a deliverable state? Deliverable state means it is a state where the buyer is bound to take the delivery of the goods. The moment the goods are being put into a deliverable state, the buyer has the knowledge of the same, the buyer should take the delivery of the goods. One fine day you went to a restaurant to collect a parcel. The moment the seller has made the food available for you and the goods are ready to be taken as a parcel, which means the food packet is in a deliverable state. That is, the buyer is bound to take the delivery of the goods. Over here, let us go on to the next part, which talks about pricing the goods. Okay, please tell me, is price one of the essentiality towards contract of sale? Law says yes. Price is one of the essentiality for the contract of sale. See, If I just talk about a normal contract, then can I say consideration is one of the essentiality for a contract? No consideration, no contract. So in a similar way, when I talk about contract of sale, in a similar way, when I talk about contract of sale, then yes, in contract of sale, price is one of the essentiality required to form a contract of sale. Price over here means it has to be money and not money's worth. If it is money's worth, it is exchange of goods, which is nothing but barter exchange, which is not allowed. If you are gifting the goods to someone, it is again having no price, which means it is not a valid essentiality. Okay, partly in money and partly in money's worth will be considered as a price and it will be considered as a sale. The price over here means money consideration, but not money's worth. Partly money's worth allowed, 100% allowed. The next concept over here is property in goods. When I talk about property in goods, then property can either be general property or special property. Already this thing we have discussed under section number 4, that whenever the seller transfers or agrees to transfer the property in goods to the buyer for a price, then the property over here stands for general property and not the special property. When I say general property, which means the seller is going to transfer or agrees to transfer the ownership in the goods to the buyer. Special property means you are just transferring some kind of interest. For example, you are transferring mere possession, which includes bailment but not selling of goods. Over here, let us discuss the next thing, that is essentiality towards contract of sale. What all are the things which are required for contract of sale? When I say contract of sale, so can I say it is nothing but a contract? Yes. So for a contract of sale, we require 6 essentialities. The very first thing we require is there must be two parties. Pretty obvious. Contract of sale is nothing but a contract. Contract of sale is nothing but a contract. And for every contract, there has to be minimum two parties. So in contract of sale as well, there must be two parties. One is the buyer, another is the seller. Wherein the main subject matter of the contract should be goods. So goods is acting as the main subject matter in contract of sale. What is goods? You have already understood under the provision of section number 2, subsection 7 of Sale of Goods Act 1913. Over here, the third essentially talks about the property in the goods must be transferable. To be more precise, we are talking about general property, that is ownership of the goods must be transferred from seller to the buyer. Yes, there must be a price, and when I say price, it has to be in form of money and not money's worth. However, partly money's worth, it is allowed. Whenever you say contract of sale, so can I say in practical life, we would like to form a valid contract of sale? Yes. And in order to form a valid contract of sale, we need to fulfill the provisions of section number 10 of Indian Contract Act 1872. We need to fulfill the provisions of section number 10 of Indian Contract Act 1872. That is nothing but essentialities of a valid contract: proper offer, proper acceptance, intention to create legal relations, etc. Last, law says contract of sale can be absolute, that is without any conditions, or contract of sale can be with conditions. If it is absolute, the best thing is nothing but a sale wherein the ownership gets transferred immediately. If it is conditional, then it is nothing but agreement to sell wherein the ownership will get transferred only after fulfillment of certain conditions, that is at a future date. So yes, friends, these are nothing but the essentialities towards contract of sale. When these 6 things comes together, you are in a position to form a contract of sale. When these 6 things comes together, yes, you are in a position to form a contract of sale. See, friends, when you wanted to form a contract, then in order to form a contract, you required an offer, acceptance, promise, consideration, agreement, enforceable by law. In a similar way, when you want to form a contract of sale, there must be buyer and seller. There must be goods, transfer of ownership, there must be some price. Yes, you need to also fulfill the provisions of section number 10 of Indian Contract Act 1872. And yes, the contract of sale can either be absolute in nature or it can even be conditional in nature. Let us go on ahead. wherein we are going to discuss a topic called as effect of destruction of goods. What is the effect when the goods are being destructed? So we are going to discuss three scenarios over here. We are going to discuss three scenarios over here. Scenario number one: goods are destroyed before the contract of sale was formed. So contract of sale is not formed, and before that only the goods are being destroyed. Then in that case, the ownership is with the seller, and when the seller itself is having the ownership, the seller itself will be having something called as the risk towards the goods. One fine day, I wanted to sell my car. But before I sell my car to Karthik, the car was already had caught fire. The car already caught fire, which I never knew. Then also I entered a contract with Karthik. Then can I say the goods was already destructed before the contract was entered? Then it is something called as void ab initio. The agreement is void, void from the beginning. Whatever is the risk belongs to the seller. The second situation says goods are destroyed after agreement to sell, but before the sale. I and Karthik came together wherein I made a promise to sell him the car on 20th January. On 20th January, the ownership will get passed on to Mr. Karthik. However, the contract was entered on 1st January. So 1st January is the date of contract and 20th January is the date of performance of the contract. But before the ownership gets transferred, my car caught fire. So can I say whatever is the contract between me and Karthik, that contract becomes void? The contract becomes void. Over here, the ownership was not yet transferred to Karthik. The ownership was there with me, that is the seller with himself. The ownership was there with the seller himself. Then in that case, whatever is the risk belongs to the seller. However, if Karthik had already paid me some advance money, then in that case, Karthik, who is acting as an aggrieved party, can claim refund of his money, and he can also claim interest on that money if he wants to. That is, he can claim damages. The third situation over here, goods are destroyed after the contract of sale. For example, on 20th January, the car is being sold to Karthik. Then on 25th January, if the car catches fire, if the ownership is already been given to the buyer, then in that case, whatever is the risk, that risk now is with the buyer himself. The contract is already been performed. The contract is executed. The last point, friends, that is modes of fixation of price. The modes of fixation of price. Is price one of the essentiality of a contract of sale? See over here. Yes, price is one of the essentiality for the contract of sale. Essentiality number 4. Price is one of the essentiality towards the contract of sale. Now, we have to fix the price. So there are many ways by which a price can be fixed. The modes of fixation of price is given under section number 9 of Sale of Goods Act 1930. Law says price can be fixed as per the contract of sale. Whatever is the amount written inside the contract of sale, that amount the buyer will pay to the seller. That is one of the way by which a price can be fixed. Or else you have not written down an amount, but you have written down a manner for which you are going to fix the price. The contract between the buyer and seller says if this thing happens, if this thing happens, if this thing happens, then this will be the price, or else this will be the price. Which means they have not communicated a particular price, but they have communicated a particular manner in order to ascertain the price. The price can be fixed as per the contract, or price can be fixed as per the manner specified inside the contract. However, price can also be fixed as per the course of dealings, that is as per trade and customs. If you take an example for price of stock market, the price of the shares in a stock market, I never fix the price. The government never fixes the price of a share. Today, the price of Reliance shares is traded at more than rupees 2000 per share. I never fixed that price, nor it was been fixed by government, nor it was been fixed by Mukesh Ambani. Why? Then the price is 2000 rupees per share, because the price over here has been fixed as per the rule of demand and supply. If in the market, there is a huge demand for the shares of Reliance, but there is a very low supply, then the price of Reliance will rise. The price of Reliance will rise. However, if there is ample amount of supply, but there is very low demand in the market, then the price will fall. So price can also be determined by the course of dealings. For example, course of dealing over here means trade and customs. Example, demand and supply rule. Over here, If price is not fixed, if price is not fixed, that does not mean the buyer will take away the goods for the free. No, buyer won't take the goods for free. Buyer will have to pay a reasonable price. When I say reasonable price, then it is not a market price. Reasonable price does not mean a market price. Reasonable price, what is reasonable? Something which is not defined. It keeps on changing from situation to situation, person to person, time to time. So one of the mode for determining the price is as per the contract, or else as per the manner specified in the contract, or as per the course of dealings. If nothing, then there will be a reasonable price the buyer will have to pay to the seller. But reasonable price never means market price. The last mode by which a price can be fixed. Law says yes, price can also be fixed by a third party. If there is a contract between a farmer and a zamindar, then yes, inside that contract, they can say that the price of the goods will be fixed by the zamindar. Zamindar is the third party, though the contract is between farmer and businessman. So, sir, can price be fixed by third party? Law says yes, price can be fixed by third party. If inside the contract it has been mentioned that the price is going to be fixed by third party, then whatever is the price the third party fixes, that price the buyer will have to pay to the seller. If the third party fails to fix the price, the contract becomes void, impossible to perform. However, if the third party is been stopped to fix the price, then in that case, the aggrieved party can terminate the contract, and for him the contract is voidable in nature. So if the third party fails to fix the price, void. But if someone is trying to stop the third party to fix the price, then in that case it is a fraud. The contract is voidable in nature. So yes, friends, this was the introduction part 1 towards Sale of Goods Act 1930. Now, friends, we are left out with conditions and warranties, transfer of ownership, and a topic called as unpaid seller. Once these three topics are over, we will be in a position to complete our Sale of Goods Act 1930. Tomorrow, I won't take more than 45 minutes to complete this balance portion of Sale of Goods Act 1930. However, balance 45 minutes I will be discussing with you all is a topic called as Limited Liability Partnership Act 2008, and I will also give you guidelines about how to write down answers for your law exams. So by tomorrow's lecture, I will be completely finishing my portion of business law. Tomorrow, you are having a lecture for 3.5 hours, wherein first 2 hours will be taken by another faculty, wherein the subject will be BCR. And last 1.5 hours, I will be taking a lecture for law. And yes, after that, we'll be having a doubt solving session for the same. So friends, this was from my side. Thank you for today. I hope so you enjoyed it. Study well. Take care. All the best. God will do the rest. Thank you.